Hi traders, in this video I'm going to be talking to you about the stock markets. Are we going to see a rebound, or is this going to be a deeper problem? Let's go take a look at some price action first of all, because I've got the S&P 500 in front of me here. We've come into the January lows, the 13th of January. In particular, we formed this low here, and the market's really kind of struggling to get anywhere near below this level at the moment. We can see that we've had sort of 3 wicks to the downside here right now, and if we were to see a significant close above these lows again, it could potentially provide an opportunity for stocks to move higher. We've got to be a little bit cautious though, because we have non-farm payroll data coming out today, and what you'll be wondering is if we were to see stronger jobs data, would that be bullish for the stock markets, or would it be bearish for the stock markets? I think in this scenario, what you typically see is that if there is stronger jobs numbers, that is better for the market, because it means that there are more people employed, and it leads to the market thinking that there are more people out there willing to spend in the economy. That is a good thing, considering the poor consumer sentiment data we've been having lately. If we go take a look at what we've got over here in terms of currency strength meter, and we have a little look at those fundamental trackers, we do have that problem with jolt job openings continuing that downward trend. Retail sales was the big one, because that now brings forecasts of GDP a lot lower as well. But consumer confidence was really down, and this could have a real knock-on effect on the stock markets in particular. However, we are coming into this area here. It does look like we're getting a strong rebound. I'll just be very cautious going into the jobs number, because I think that if we get strong jobs data, then this level could in particular hold, and we could see the market push higher from this area here. However, if we do start to see negative employment change, then we could see a continuation to the downside, possibly heading down towards this 5,600 area as well. Now, the reason I say this, or the reason why we're looking into this, is because in our live stream, I had a really good question by one of our subscribers, Eddie, who pointed out the fact that there's a big seasonal pattern going on at the moment, and there is. This is the S&P 500 over a 10-year seasonal trend. So what it does, it tracks the average movement of price over the past 10 years. Now we can see typically from February 15th down to March 23rd that the stock market, or the S&P 500 in particular, actually falls through this period. So if anything, the market is just performing how it has done over the average of 10 years. Because if I just go and grab price, or what I can do actually is just go to more here and compare year, add 2025 on here, we can see that actually we started to fall around about the 19th of February. So just a few days later than the average, and the market is moving in line with this. So we could see a little bit more downside to come until around about the 23rd of March, where we typically see quite a strong rebound to the upside over the past 10 years. Between the 22nd of March and the 17th of April, there's a 70% win rate, with the market rallying at least 3.66%. So very strong seasonal pattern after March. So really, could we expect further downside for the US stock market until then? Or at least could we imagine the market just kind of slowly stabilizing towards these levels for then a potential move back to the upside? One other thing I wanted to point out, just using that seasonal data, is that in the past 10 years, the max drop has been quite significant. So if I just grab those dates again from the 15th to the 23rd of March, you can see actually the biggest drop that we had was 7%. I'm ignoring COVID because COVID is a big outlier. But between that period, the biggest move that we've had so far is 7% to the downside. Now, if I measure from the sort of high that we've had, or at least the 15th of February candle, which I'm going to take the close on the Friday, the 14th, and we're going to use that and kind of measure that down. Market's already down 6.15%. So that's quite a significant move that we've already seen from a seasonal pattern anyway. Remember, the average is 4%, and we've beaten that average by, just over 2% right now. So if we see continuation, especially beyond that kind of 7% area, which is around about this kind of 56.90 area, if we see the market try and breach that, I think that's a significant sign that we might start to see either something bigger going on in the market, or we'll see the market snap back from that point because it's extended beyond the average. So keep an eye on your stock market, because if the stock market starts to rally, what does that mean? It means that we're likely going back to risk on sentiment as well. Probably means that you're going to see the Japanese yen sell off, a little bit of dollar weakness continuation as well, perhaps a little bit downside in gold as the market tries to shift back a little bit of that sentiment. So keep an eye on this. It's going to be pretty crucial going forward. I'm going to keep an eye on this 4-hour chart because I think this is a good medium-term chart to look at. If we start breaking back into new highs, that would be a big sign for me that we are going to see a potential continuation back and see stock markets climb again. But at the moment, market is down, it's really struggling to get any kind of momentum. There is some momentum here, but I don't really want to be putting risk on ahead of NFP. So thanks for watching this video. I hope you enjoyed it. If you did, give it a thumbs up, subscribe if you are new to the channel, and I'll speak to you very soon.